Hey, it's Jim, and this is FRM Part 2, the topic on operational risk and resilience, and the chapter on a case study of financial crime and fraud. If you're like me, you've been waiting for this chapter. After watching The Godfather 50 times or 100 times, let me just quickly remind you that Vito Corleone owned an olive oil business in which he funneled the profits from his crime engagements through that legitimate business. Of course, there are other movies. I'm hoping you've watched these other movies too, like Casino or The Firm with Tom Selleck, or even the more recent Ocean's 11 and maybe even Shawshank Redemption. So this is a really awesome opportunity for us to use, that silly stuff that we learn in the entertainment field and apply it to something that is, of course, very serious. One of the interesting things about the beginning of this chapter is that GARP defines fraud, money laundering, terrorism financing as an integral component of the non-financial risk management for banks. And so, of course, it falls under this heading of operational risk. Remember that definition of operational risk that we've gone over multiple times, the failures or inadequacies of, people, processes, or systems. So think about that in the context of Vito and Michael Corleone. All right, so let's talk about these learning objectives, just two of them. Look at the second one, which was almost identical to the final learning objective that we had in a different slide deck, where we want to summarize the findings and learn from that particular case, the USAA case study. Now, I think the most obvious question from that, and we'll talk about this at the end of the slide deck, is that USAA failed to do lots and lots of things, and they were caught in their failure. However, there was no case, there was no actual crime ever committed. And so it's important to know and be able to answer on the exam that even though no crime was committed, this is still a failure of, well, let me just go back here quickly. It's a failure of efficient operational risk management. And then, and secondarily, and this might even be more important, it puts that financial institution in a position to challenge its resilience. Lots of questions can come up from that first learning objective, elements of a control framework. Do you remember a couple of recordings ago, we discussed the concept of that Swiss cheese defense, where we had, bunches of layers of Swiss cheese. And so when you looked at it, you couldn't see any holes. So clearly there are going to be holes in our exposure to things like fraud and money laundering and terrorism financing. But if you have all of these layers, then you can't see through them. And then that's a great defense mechanism. In fact, the chapter does emphasizes that there needs to be layers. And in fact, the chapter uses that term, layers upon people upon layers to prevent all these things from happening. So let's go ahead and start with just a quick definition of financial crime from our authority over in England. Wide range of activities: money laundering, tax evasion, fraud, identity theft, and any other deceptive practices. And there's what the Financial Conduct Authority uses as the definition down there at the bottom: fraud or dishonesty, misconduct, handling the proceeds of crime, or financing terrorism. Now, the chapter goes on to describe two subcategories of internal fraud. So look at the very top, internal fraud. So let's go back to that. Let's go back to that learning objective. So in this control framework, we need to be able to control both internally. Here, watch this slide, and the next slide we'll go over to externally. So think about potential questions on the exam in which you're, provided with some type of a scenario, and one answer would be internal and the other answer would be external, and maybe some other kinds of answers there. So focus here on internal fraud for just a second. And so the Basel Committee for Bank Safety has, a pretty good idea of what goes on internal fraud, intended to defraud, misappropriate property, or circumvent regulations, and keep going all the way to the very bottom of that sentence, which involve at least one internal party. So the obvious exam question would be something like this. All right, we have a third party here and another third party here, and then some other people over here, and it's just one person internally who's giving those parties access to the operations of the financial institution. Well, that's still a definition of internal fraud. And so there are these two subcategories: unauthorized activities. These are things like, saying that I bought 100 shares of stock or 100 options at $10 and recording them at $100 or $1, whichever would be favorable there. Unauthorized transactions. I've said to you guys before, I'm a big reader, and I read all sorts of mystery novels, especially private detectives. And the private detectives, they always have somebody somewhere where they can get private information. They'll call up the phone company and say, hey, can you give me this phone number? Or they'll call up the utility number and say, can you get me this address for this particular person? Or they'll call a financial institution and say, hey, can you get me the Social Security number and the amount of deposits for this particular person. And the private detective always then makes available, like tickets to the Super Bowl or whatever it is. So unauthorized transactions. And then theft and fraud. So we probably know what that is. How about external fraud? So notice, the definition sounds an awful lot like the internal fraud definition, but the key thing is by a third party or third parties. And so two subcomponents here. We need to worry about system security, and this is just hacking. We learned about hacking in a previous recording. And if you're regular readers of the Wall Street Journal, like I always suggest that you should be, you'll read about hacking into computers and information being lost or stolen, et cetera, et cetera. You guys know all about that. And then the second subcategory, theft and fraud. So note the similarities between this particular slide for internal and this particular slide for external fraud. But the key difference is here, it's all third parties, and back here, it's at least one internal party. Now, of course, the Vito Corleone and the Godfather movie did not motivate the European Parliament and Council to make this directive. But of course, the movies and books are a lot of times etched in reality. And so sooner or later, we needed some authority to come and say, what does anti-money laundering mean? So there's a good definition at the top: organizing, facilitating, concealing criminal activities. And so notice we have some gold coins there throughout the world: property conversion, abetting and facilitating concealment, possession of property derived from criminal activity. These make perfect sense in the context of all those movies that we just described. And so I'm guessing that GARP would give you a question stem that would sound an awful lot like a movie that has already been made or one that is being made. All right, I want to skip around here real quick. Go ahead. In the meantime, go ahead and get out your phones. Here we've got a slide on some processes or elements of internal fraud management. Then we have one for external fraud management. And then here we're going to have one on anti-money laundering risk management. So I want you to take pictures of these three slides so that you have them in your file, so that when you have a private moment, you can just get out your phone, and instead of scrolling through whatever it is that you scroll through that is mindless, go ahead and scroll through some of Jim's slides so that we can make sure that we pass this exam. All right, internal fraud management. I think that very first one at the top left is among the most important of these. Screening at onboarding. All right, so internal, what does that mean? That means we have these employees. So when we hire an employee, we ask them a bunch of questions. We say something like, hey, look, if you saw $10,000 sitting over there, would you A, take it home and spend it, or B, turn it over to your supervisor? You have people a lot smarter than I am will have a series of those questions that are not quite as obvious, but will be able to determine whether or not someone is trustworthy. And you remember, I've said this before and I'm going to repeat it. I say this to my children and I say this to my students. I say, look, if you have integrity in small things, then you will have integrity in big things. So that's all part of the screening at and during the hiring process. And then, of course, skip over to the purple one. The purple column, there's monitoring for abnormal patterns. So once we screen at initiation, then we ought to be pretty confident that we've hired trustworthy and honest employees. However, things happen over time and the personal scenarios change. So we need to monitor there. And do you remember in that very last recording that I made, we talked about risk management and there was a circle in there and we said something like, look, these can be done in sequence or they can be done simultaneously. Well, that probably doesn't apply as exactly in this case as it did back in that case, but I want you to think of selection and prevention and detection and deterrence as ongoing. And how about nearly simultaneous? And then, of course, due diligence. Of course, we're going to work on due diligence for our current and future and potential employees. But this is important there. We need to make certain that, and we've talked about this before, that whenever we hire a third party, suppose we hire a third party over there to take care of all of our ATM machines. So what do we need to make certain? We need to make certain that those people over there, that they have the same kind of a risk culture that we have and the same attitude toward fraud and money laundering and terrorism financing. And so we make sure that those third parties are the same kind of people that we have inside of our organization or our financial institution. Now, of course, having said that, that's a lot more difficult to do than inside. Nevertheless, we need to make the effort. You remember we talked about the importance of the chief risk officer establishing the risk culture and the risk tone of the organization. And so here's where the chief risk officer comes in and says something like, look, here's our goal. Goal of the financial institution is to maximize shareholder wealth. We have a board of directors that is determining upper level and executive leadership team compensation and non-pecuniary benefits. How about if I just call those perks? And we're arranging this series of compensation agreements so that you can worry about all the things that are important, like risk management, like risk culture, like risk tone. All right, what's prevention? This is that Swiss cheese that I was talking about. Segregation of duties, authorizations, access rights, delegation of authorities. I mean, this makes perfect sense if we say something like, look, you see that door over there? Don't go through that door because there are people behind that door that are doing stuff that you don't need to know about. Segregation of duties. And so what that does is that establishes a wall. It's kind of a fictional wall or a make-believe wall, but we have our job, they have their job, and there's that kind of Swiss cheese stuff. So how do we monitor? How do we detect? Of course, we do lots and lots of monitoring. And the only way to monitor in an efficient manner here internally is to collect data. So we collect lots and lots of data. And that's why it's so important as good financial risk managers to have a great foundation in time series regression, cross-sectional regressions, correlation analysis, copula analysis, all that stuff that we have talked about. Going back to part one, we need to understand all that so we can monitor, but so that we can detect abnormal patterns. And we need to have a whistleblowing policy. This is important. And, we started learning about this here in the United States, 2 or 3 decades ago, that you have to have a protection for somebody who's going to call out lots and lots of his or her colleagues for, aiding and abetting fraud or money laundering or whatever it is. So we need to establish an efficient whistleblowing policy so that if one of us sees something that we feel comfortable that we can come forth and say it through the appropriate protocols and processes so we won't get fired or we won't have something bad happen to us. Detection also occurs because we have superior leaders. So what's the job of the board of directors? To hire and fire the executive management team, which means that those individuals then hire the other team leaders, and those people then are responsible for detecting. Deterrence, you think about the high-profile cases, over the last, 20 years, Martha Stewart, Bernie Madoff, and this dude recently that has 3 letters in his name. What's the big deterrent? The big deterrent is prison, right? And what does that mean? Well, the next deterrent is, all right, so if we can commit a crime that does not rise to the level of prison, well, then we have loss of our job and loss of reputation. Ivan Boesky went to prison. You guys, maybe you don't even know that guy's name. He went to jail back in the 1980s, and he was a Bond guy, and he came out of prison, and he was never allowed to hold another position in the financial services industry. So, of course, he lost reputation and access and all that kind of stuff. Now, another deterrent is this notion that there is a forensic analysis always going on, so that if you do this and this and this and this, that someone's going to come on and audit this and this and this, and they'll be able to say, oh, you know what, you violated our policy on fraud, and therefore you're fired, and we're going to send you over to the SEC. Now, what the reading emphasizes, I'm not sure this could come up as a question. I was thinking about this, but lots and lots of former police officers, former FBI, former accounting fraud specialists, lots of these individuals go work for the chief risk officer and pursue this forensic analysis. And by the way, the chapter makes a point that most financial institutions have a process and a policy of zero tolerance. And what that means is that if you're caught doing something, even if it's only this big, zero tolerance means that you're going to be terminated. And by the way, detecting this from an internal standpoint applies to acts of commission, but also acts of omission. If you see something and you fail to act, and then we lose $100 million, well, then that's a violation. All right, so did you take a picture of that one? I hope you did. Let's move on to this one here, external fraud management. And I'm just going to go back here really quickly. Go back to that first column. Look under due diligence on employees and third parties. All right, so this is what we're doing. External fraud includes third parties, but it also includes anybody else who has at least some type of access to any of our systems. So look at that first step. Develop a comprehensive fraud prevention program that focuses on external fraud. So this is separate from all this stuff that we've done here, although clearly there will be some similarities. Yeah, data analytics, this is super important. This is going back here to, where was I here? The monitoring. So we need to know about regressions. We need to know about copulas. We need to know about all that stuff. And I'm going to go ahead and offer support for data analytics in the financial institution industry. And I'm going to just go ahead and pause and give my editorialization here. I am completely unfavored in data analytics as it applies to football, because football coaches have no idea when to go for 2 and when not to go for 2. All right, there, I got that off of my chest. All right, data analytics. This means, almost anything that you can, including back here, monitoring for abnormal patterns, so suspicious activities, right? Training programs, GARP is super sensitive about this, as are other institutions out there, that we need to train our staff so that they can, detect, investigate, and report and do all those kinds of stuff. Then, of course, we have security protocols, passwords. Every time I log into my account at school, I got to go through this step over here and that step over there. And I oftentimes wonder, who in the heck would go to great trouble to have access to my old exams or whatever the heck else I have on my computer? But of course, the school, they have to protect us, and financial institutions have an even greater responsibility. Yeah, review customer accounts regularly. Remember that the reviewing of customer accounts regularly, that should be done regularly, right? But it should come from the board and the chief risk officer. But remember, that also comes from governing bodies and the Security and Exchange Commission, which says things like, you ought to review customer accounts regularly. And then we're going to investigate reports and have some type of an action plan. All right, so we found out that Jim has done this. Well, where does this fall in the spectrum of violations? Does it mean this or this or this? Swinging back to zero tolerance, what does it mean? What's that action plan? And then do we need to get the government involved? Do we not need to get the government involved? Do we? Who is important? Who is not important? Et cetera, et cetera. Here's probably a couple of good exam questions. 3 main phases in money laundering. So there's placement, then there's layering, then there's integration. So let's go back to the Godfather example. And by the way, for those of you who've never seen The Godfather, I want you to stop this recording right now and go watch The Godfather for 2 hours. I was just kidding there. You don't need to stop. All right, so what does the chapter call this? Ill-gotten funds, whatever that means, from fraud or terrorism financing or embezzlement or whatever it is. So their placement, they're placed into the legitimate financial system. What typically happens then, if I show up, suppose I robbed a bank over there and I robbed it of $10 million. And for some strange reason, I have $10 million in a wheelbarrow. I don't even know how much $10 million would weigh, even if it's in $100 bills. But suppose I have a big old wheelbarrow and I show up at your bank and I walk in with a wheelbarrow and I say, I would like to make a deposit. What are you going to think? Clearly, if you say, oh, sure, we'll take it all, like Sanchez did to James Bond in that awesome James Bond movie, License to Kill. Sanchez just took all that money from James Bond. He had it in 2 big suitcases. But clearly, this is not going to happen everywhere. You're going to scratch your head and say, hey, Jim, could you tell us, what have you been doing over the last couple of days? So, of course, you need to be aware that I'm clearly not going to do that. But I might take, my little purse or something and put $1 million in this bank, $1 million in that bank, $1 million in that bank. Now, of course, $1 million is still too much, but maybe 10,000 and 10,000 or 100,000. It depends on who I know. And, of course, it depends on, let me go back here. It depends on, do I have a friend working for this financial institution? Do I have a friend who is a third party for this financial institution? All right, layering then simply means that we're going to take this money that has been deposited in some form and we're going to start transferring it around from different accounts, either inside of that bank or outside of that bank, and probably across international borders. And so the goal there, and this might be a good exam question, look at that second block point. The goal there might be, what's the purpose of this? And the purpose is to confuse where that original source is. You think of an auditor, if you've done this, say 25 times, and the auditor goes from the 25th back to the 24th, and then the 23rd, and then the 22nd, and all the way back, sooner or later, you might think that the auditor would become tired and say, oh, I'm never going to get to the end of this. I'm going home and having supper. And then integration means that it's reintroduced back into making legitimate investments, like buying a U.S. Treasury bond. So what happens after integration is that it appears as though these, and look at the very top, these ill-gotten funds are now legitimate. So here's a case study, just a quick case study that we came up with. So we have a bank account opened by a student. 2 foreign travel agencies wire money into that account. Both of those agencies were fictitious and created by the student to launder illicit drug proceeds. Money continues to flow in there. So there's the placement. The money comes into the account. And what happens with layering? Well, what we can do is, as this student, we can go in and start wiring money to our friends, either inside of this bank or outside of this bank. We can purchase prepaid debit cards. We can overpay credit cards. We can make checks to travel agencies. We can overpay tuition in order to get refunds. And so we do all this kind of stuff. And sooner or later, those refunds then are commingled with those wired funds. So you have some ill-gotten and some legitimate. You start smashing them together, and that's where the integration comes in, combined funds. The student uses a luxurious lifestyle. I never had a luxurious lifestyle back when I was in college, living in the dorm room with my roommate, who was my best friend back then and still is today. All right, you got your phones out, so let's go ahead and take this third picture. Notice we have selection, prevention, detection, and deterrence. And so these are super similar to what we've done before, but they are unique to the anti-money laundering element of this particular chapter. So what we need to do first is to, what did we do back here in selection? What was that thing that way back here? Screening at onboarding. So we're going to do the same thing, screening at onboarding, but we're not really hiring someone to work for us. What we're doing is we're going to make sure that when Jim shows up with a wheelbarrow full of money, that we screen him, right? Customer due diligence. So that means KYC. Know your customer. So before I open up the account, you're going to say, hey, Jim, do you have a driver's license? So I show you a driver's license. It has my picture, but it has Vito Corleone on it, New York City. And so you look at me and you say, oh, how long have you been living in New York City? And I say, well, ever since I opened up my olive oil business. And then you say, well, what's your Social Security number? And then I rattle off a number and you type it into your computer and it's the Social Security number of, some poor guy who died 20 years ago. All right, so customer due diligence, identification and verification, not only of the customer, but also of the origin of the funds. And then what we want, ideally, right, we want to hire high integrity employees, and we want to provide goods and services to high integrity customers. All right, prevention, identifying the risk driving factors. So how do we identify those driving factors? Well, we do some staff training, we do delegation of responsibilities. The first identifying driving risk factor is client walks in the bank with a wheelbarrow full of money. That's probably a risk factor. Now, other risk driving factors are criminal area in the behavior, reading the Wall Street Journal, having a relationship with the local and the National Police Department, who will be able to give us kind of a series on what to look for, what is the recent trend. That's probably a good thing to know about prevention. All right, detection, abnormal behaviors, we've been through that. Monitoring software, reconciliation lists. This is one of the first things that I learned as my undergraduate days as an accounting student is, you have a bunch of stuff over here, maybe call them debits, and you have a bunch of stuff over here, maybe call them credits. And in the end, they have to sum to the same number. And so this process of reconciliation is extremely important in this risk management. All right, deterrence, legal proceedings, right, law enforcement, and then closing your account. So here's the second learning objective. What did I say in that very first slide? I said something like, hey, look at the third teardrop point. Inadequate internal controls, reporting, staffing, training, third-party risk management. So these were all present at this savings bank, but there was no known fraud or terrorism financing or embezzlement or money laundering. None of that went on. Yet, USAA still was fined $140 million for willingly failing to implement. And this, of course, is a violation of a law here in the United States and their laws throughout the world, of course. Look at the second teardrop point, did not meet minimum requirements. All right, so boy, what did I just say there? That's probably three good exam questions there. But notice when we skip down to that last teardrop point, there was a new transaction monitoring system in 2021. So think about what this is. So this was in March of 2022 about the fine. But in 2021, USAA, they tried to come on board. They tried to do all the stuff that we've talked about so far, but it caused an unmanageable number of alerts. So we tried to solve the problem and we made it worse. Unreasonably delayed detection. Oh man, this is exactly what happens with lots and lots of banks out there. I won't go ahead and name them. All right, so banks across have been penalized for inadequate anti-money laundering controls. There's some fines, $5.1 billion. Sanctions require costly AML remediation programs, including all those things listed there. COVID, of course, changes life. Banks have to adapt to these evolving threats. So that's super important. Remember the word evolving, remember the word dynamic in an exam, because no matter what we do in all of this, internal and external and anti-money laundering, that somebody else is out there going to figure out a way to beat us. And it's exactly like that movie that I mentioned earlier, Ocean's 11. Poor Benedict was managing this casino, and these 11 dudes came in and they took advantage of all of the holes inside of the Swiss cheese. And in the end, what did they do? They walked off with $180 million worth of funds that were being held because there was a big boxing match that was going on that night, and people bet on the boxing match. So there's your homework assignment. Go watch that movie and ask yourself the question, what did Terry Benedict do that was any consistency with what we talked about in so far in this slide deck? And of course, the answer is almost zero. And that takes us through our 2 learning objectives. So this was fun for me. Go ahead and watch The Godfather and Ocean's 11, but not at the expense of studying. Maybe wait till after you pass the exam. So thanks for watching and good luck studying.